Today we're going to talk about student loan forbearance. What does it mean? What are the pitfalls? And ultimately, is it right for you in October when student loan payments are set to resume after a 3-year freeze? Forbearance means that you temporarily can stop making student loan payments. For the last 3 years, all federal student loans were placed in a special type of forbearance called the student loan pause or payment freeze. During that time, all federal loan borrowers did not have to make payments on principal and interest. And this pause was automatic, meaning you did not have to apply. Everyone was included regardless of their financial situation. Now that this program is coming to an end in October, if you feel like you still need time before you start repaying your student loans again, there are 2 types of forbearance that you could request: general and mandatory. With general forbearance, you have to request it and your servicer will decide whether they want to grant it or not. And for that reason, general forbearance is often called discretionary forbearance. You can request it for reasons like financial difficulties, because you lost your job, because of medical expenses, or some temporary financial struggle. You can apply for up to 12 months, and if at the end of those 12 months you still need more time, you can apply again, and the max is 3 years. The second type of forbearance is called mandatory forbearance. You still have to apply, but the difference is that if you meet the requirements, your servicer has to grant it. They cannot deny you. This type of forbearance is for very specific categories of borrowers. For example, doctors and dentists during their residency, teachers, or members of the National Guard. You need to do your research to make sure you qualify and provide proof. And you should start at studentaid.gov. These options are all for federal loans, but forbearance could also be a possibility for privately held loans. You need to talk to your servicer and ask what terms they could offer. But most people with federal loans will fall under the general forbearance category. So you've been granted forbearance. Now what? During the time of forbearance, you don't have to make any payments, and that's great news. But here's the downside. Even though you're not making payments, interest is still accruing, so the total amount you owe is ballooning. Furthermore, if you're working on student loan forgiveness, forbearance might slow down that process. For example, the Public Service Loan Forgiveness Program, also known as PSLF, requires 10 years of on-time payments for the loans to be forgiven. Any months spent on forbearance do not count towards the 120 months that are required for this program. Another example is the SAVE plan, under which after 20 or 25 years, any unpaid portion of your loan will be forgiven. But any time spent on forbearance will not count. Is forbearance a good option for you in October when the payment freeze ends? As always, the answer is it depends. Forbearance is not a good long-term solution, but it could be a good short-term solution. For example, if you lost your job and you need a little bit more time to improve your cash flow until you find another job. If you view forbearance as a temporary solution, it could work well for your finances. But if you need more long-term options, make sure to check out our other episodes where we go into income-based repayment plans and other options for borrowers. And as always, make sure to check back on our Explainomics playlist for more content like this, and we'll see you next time.